Okay, Chip Frame here. We're going to get started. We have another great program for you today. We have Bob and Mike here one more time from Path Trading Partners. This will be the third time they've presented a webinar for us. Again, they're going to be talking about the Nadex spreads, basically just building on what they've taught before so you get more and more detail. Just a quick note, the two previous webinars, which were done on spreads, you can find those on the Nadex YouTube channel under webinar archives. And so this third webinar will be appearing very shortly, either tomorrow or the next day, so you can review and go over all this stuff that you've learned. So anyway, one more thing. Bob and Mike have agreed to do a fourth webinar on spreads, so we consider ourselves very lucky, and that will be next Tuesday. And so you can register on that for those webinars on the registration page on the homepage on Nadex, and that should be up tomorrow sometime. So I'll leave it there. So Bob and Mike, take it away.
Thanks, guys, for Nadex, Chip, Frame, as always, the entire Nadex exchange and community for allowing us to talk to you guys. And just before I begin, we talked about doing a fourth webinar with the guys at Nadex, and part of the reason that we wanted to do that, and they were kind enough to allow us to do that, is there's parts and structures to these spreads that I feel after this particular class you're going to understand things about the spreads, but you're still not going to know which ones you should choose and what the qualities of them are at different times, with different expirations, with different activities of the underlying or the indicative indices. So we decided to do a fourth one, and again, Nadex was kind enough to allow us to do it because our number one thing, myself and Mike as individuals and Path Trading Partners as a company, is that we don't just want you guys to purchase strategies regardless of who they're from. We don't care if they're from us or somebody else. We want you guys to learn things and purchase strategies without understanding what you're trading. I've written about it, I've talked about it, and there's qualities and structure that you need to understand before you trade these things. Nadex has some of the best products out there for beginners, for intermediate traders, and for professionals as well. And this is something that I've come to learn over the last 8 months or so of looking at these products. And we're really excited to talk about them. We're really excited to teach about them. But it's really, really important that you guys know that any sort of trading in general, it's just not child's play. It's all serious, and you should understand what you're doing before you get involved. So this fourth webinar that we're going to do next week, Tuesday, that Chip mentioned, is kind of the capstone of what we've been teaching about the construct and to get a full understanding of the Nadex spreads themselves. So as always, I want to read the risk statement, and I want you guys to pay attention to it because it is not just cover your butt kind of stuff. The risk statement is extremely important. I've gone into it before. You can listen to the old webinars. I'll probably go into it again. If any of you join Path Trading Partners or hear me speak again, risk statements are important because the content in these statements is actually true and actually matters. This presentation is for information purposes only and does not constitute investment advice, nor an offer, solicitation, or recommendation to acquire or dispose of any investment or to engage in any other transaction. Excuse me. This presentation is not intended for solicitation purposes, but only for use as general information. All descriptions, examples, and calculations contained in this publication are for illustrative purposes only. The risk of loss in trading can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition. Past performance is not indicative of future results. I spent a little time in the first two webinars on different parts of the risk statement. So I just want to point out that all descriptions, examples, and calculations contained in this publication are for illustrative purposes only. That speaks to you understanding what it is that you're trading. If Mike or myself or somebody else doing a webinar on behalf of Nadex or anybody else has a calculation incorrect, and you base your trading on that calculation rather than the understanding of the actual product or trade that you're going to put on, you have to look in the mirror on that. So that's what this risk statement is trying to do. It's trying to get you guys to understand that you have to take responsibility for the actions you make, the actions you take. We can guide you, but we can't stop you from making mistakes, and we can't necessarily put the right trades into your account. We've gone over this in 1 and 2. Path Trading Partners is an education firm, and we created it to not only educate, but to support and back traders in Nadex products. Okay, we'll probably expand that at some point, but right now we're really focused on the Nadex exchange. It is a regulated exchange. They have really, really good products for most people at most levels, so we really want to focus on that. And we are a firm that believes in long-term success in trading. All right, so we cover time frames and trades dictated to us by markets and products and price action. We don't want to go out looking for a trade. We don't want to be the people who say, I'm an oil trader, and you just go trade oil. That's not what we're about. Okay, we're not emotional about things, and we're not about bragging at cocktail parties. We're about doing things the right way. That's what Path Trading Partners is. That's what Mike and I are about, and partnering with Nadex really sort of fits into that. Again, bios. I've shown you these before. I'm going to pause on this page for a second so that if you're watching the recording or if you actually want to read about that handsome guy in the corner, you can pause here and read that. I'm just saying, you're a handsome guy.
Oh boy.
If you want to do that, you want to pause and read his background, or if you want to pause and read mine, there's a guy that looks like Shrek up there with Becky Quick. That's me. Pausing for a second so you guys can look at this on the recording. Don't really want to spend time talking about myself here. So let's get right into what we're going to talk about. We're going to start off, as we always do, with a prior class review. And in the prior class, we examined the concept of how a Nadex spread is really either a vertical call debit spread or a vertical put debit spread, depending on the direction of the trade. And these vertical spreads are constructed by being long one call or put and short another call or put at a different strike price. One of the things that I think escapes people is that Nadex binary options and spreads are options. So you're going into a simplified version of some of the complex option strategies that the other exchanges offer to you, but Nadex offers them in a simple and easy to understand fashion. Now, it's not as easy to understand as 2 plus 2, and that's what these webinars are about. And that's why in the last 2 webinars, mainly number 2, we examine the risk graphs as they appear at expiration. It's an important thing for you guys to know that while these are some of the simplest forms of complex options that we've seen, they are still complex options. Trading Nadex products is not child's play. It's not something to toy with. It's something to learn. So let's take a look again and review at what a vertical debit bull call spread looks like. You look at the small image on the left here, all right, and you see long one call. Again, keep in mind as we're looking at graphs throughout this presentation that left to right is the underlying or the indicative index, okay, moving higher or lower in price. That's the left to right. And then above the center line is profitability of your position. Below the center line is loss of your position, right? Now, if you look at it right here, here's where you make money on the way up, excuse me, on a long lower strike call. And here is where you make money up on this side here above the center line at a short upper strike call. Okay, so if you're short an upper strike call, okay, you lose money as the price goes higher, right? Because you're short it. That's typical option. Now when you add these two together, you get a graph that looks like this, right? It's these two graphs to the left added together, and herein is where the Nadex spread looks basically the same. It's the green to the red. This is the graph we looked at in the last class. Okay, if you don't understand that yet, I completely get that. These are things that don't just click in someone's mind. You may want to go back and watch the recording for number 2, but this is what a vertical debit bull call spread looks like, all right? And the offsetting positions are represented by these dashed yellow lines. too far.
Here, let me get it back to what. Okay, there, Bob. There we go.
There we go. All right.
Perfect.
Here is what a vertical debit bear put spread looks like. Again, you've got the graph of a long upper strike put, right? So if you're long a put, here is the way the graph would look. Okay, again, profitability. The underlying is going lower, and the profitability moves up. It moves up into the unusual. Normally, you're used to seeing something that goes from the bottom left to the top right when it's profitable, right? That's not the case in these option graphs. Something you have to remember in the option graphs is that the upper part above the horizontal line represents profitability of your position, okay? So if you're long an upper strike put, you're moving in this direction because the underlying is going lower, and as the underlying goes lower, you start to make money on the upside. So this is a profitable area, the upper left, okay? Short a lower strike put. Again, you make the most money if it expires worthless because you're short it. As the price goes down, the lower strike put begins to increase in value. You are short that lower strike put, you begin to lose money. And the combination of the two of them creates this kind of a graph. Again, this is mostly a review from the second webinar. And then here is the offsetting positions represented by the dash yellow lines again. Keep in mind as we look at more and more of these graphs that the bottom half here represents the underlying, and above the center line is what represents profitability or not. Okay? The vertical line represents the midpoint of the underlying and the strike price of the option that you're in.
Yeah, and just to recap, guys, everything you do with Nadex spreads are always debit spreads. So that's why we're doing the Debit Bear Put spread and the Debit Bull Call spread. We're never looking at credit spreads in these, as we covered last week also.
So the main point of webinar number 3 is explaining and understanding the concept of option moneyness. Okay, that's the big point we want to make. In the option world, there is a concept called moneyness. And moneyness is the relative position of the underlying with respect to the strike price of the option. That sounds a lot more complicated than it is. All right, so let me read that one more time. Moneyness is the relative position of the underlying with respect to the strike price of the option. Since Nadex spreads are a form of vertical option spreads, they also have the concept of moneyness. Okay, this is going to become much more clear and much more simple in a minute. So let's talk about Nadex spread moneyness. There are 3 main categories of moneyness. Out of the money, or OTM, at the money, or ATM, and in the money, or ITM. Okay, those are the 3 types of moneyness. You've probably heard these before. There may be people out there who've heard them, and I don't want this to sound bad, but sometimes people pretend they understand things that they don't. The understanding of the moneyness actually goes a long way to choosing which particular Nadex spread you're going to trade at which particular time. All right, it goes deeper and deeper into strategy when you know about OTM, ATM, and ITM. There's also the concept of deep in the money or deep ITM and deep out of the money, which are just modifiers of in the money and out of the money.
So it's really important. One of the things we're trying to do here, guys, is get everybody at the same baseline. So in future webinars, if we say we're looking at a certain spread and we're looking to put it on at the money, or we're looking to put it on in the money at what we call the null point, everybody will know what that means. And then we can also keep building on this concept, like in our next webinar, when we get really into the Greeks and how they affect these spreads. You'll know when we say, you know, this, when the spread's at the money and the delta's doing this, everybody will say, oh, I know what at the money means, or I know what in the money or out of the money means. So we're baselining, so we're all speaking the same language. And the more we review this, and the more it just becomes part of everybody's vocabulary, it makes the whole teaching process streamlined.
It also makes conversation amongst traders easier and more clear, and that's actually going to be a big part of your careers in the future, is communicating with like-minded traders and saying that, you know, I put on this in the money trade, you know, the premium wasn't so bad. Talking and using these phrases, you'll be able to communicate ideas back and forth. One of the things Mike and I have experienced over the years is that we teach people foundation, construct, and good habits, and then over time they end up developing their own strategies anyway based off of these things. So it's very, very important that the foundation is built, and that's what we're trying to do with these 4 webinars. So let's look a little bit at out of the money. It's a fairly simple concept to understand. We refer to a Nadex spread being out of the money when the price of the underlying is below the floor price when trading the spread long. Conversely, if the price of the underlying is above the ceiling price when you're trading the spread short, it is also out of the money. All right, so just think about the floor and the ceiling, and we have an example on the next slide. Okay, if the US 500 is trading anywhere below the floor price of 1900 in this particular example, this is a 1900-1940 spread. Okay, if it's trading anywhere below 1900, it is considered to be out of the money. Okay, it's a pretty simple concept. If you think of money being in between the floor and the ceiling, it's a fairly simple concept to grasp. On the short side, if the US 500 is trading anywhere above the ceiling price of 1940, then the spread's considered to be out of the money. Okay? Notice in this particular graph, the floor price is on the top of the graph and the ceiling price is on the bottom. That may look like a typo to a lot of people, but again, that's correct. Why? Because in option, profitability is up here, right? And loss is down here. So that's something I wanted to point out because you're going to see this and people might be thinking, wait, they got that wrong. That should be ceiling price. That should be floor price. Not in an options graph. Profitability is above the center line. So if you're short, where are you profitable? You're profitable if the price is lower, not higher. Okay? Let's look at a deep out of the money. If the price of the underlying is trading way below the floor price for a long spread, it can be referred to as deep out of the money. For example, if the US 500 is trading at 1850 and the floor price is 1900, the long spread is deep out of the money. If the price of the underlying is trading way above the ceiling price for a short spread, it can be referred to as deep out of the money. For example, if the US 500 is trading at 1980 and the ceiling price is 1940, the short spread is deep out of the money. So again, pretty simple concept when you think of the spreads themselves, right? The floor and the ceiling, in between there as being the money, so to speak. Which brings us to at the money. We refer to a Nadex spread being at the money when the price of the underlying is trading at the floor price when you're trading the spread long. Conversely, if the price of the underlying is trading at the ceiling price when trading the spread short, it is also at the money. It's easier to see these as actual visual examples, right? If the US 500, the underlying, the indicative index, is trading at the floor price of 1900, then the spread is considered to be at the money. So again, using that same example, the US 500, 1900-1940 spread, a 4:15 Eastern Time spread. If the indicative index is at 1900 or 1901 or 1899, right in that area, okay, it's considered to be at the money. Okay, there's a little bit of leeway in what at the money is. All right, but essentially it works the same way every time. Whoops, too far again. All right, on a short spread, if the US 500 is trading at the ceiling price of 1940, then the spread is considered to be at the money. Again, couple of things. 1900 to 1940 spread. The indicative index is trading at 1940, right? You want to be short. It is at the money. And again, this is not backwards. This is correct. Okay, because in option graphs, you'd have a center point. Okay, profitability is above that center point. So if you're short, what do you want? You want the underlying to go from right to left or lower, and your profitability to go up and to the left, which would be the floor price. I'm off the subject a tiny bit, but at the money on a short spread would be, again, in this particular example, 1900 to 1940. If the indicative index, the US 500, is trading at about 1940 or 1939.80 or 1940.10, okay, it's considered to be at the money. Let's talk about in the money. I think you can kind of get where I'm going from this now. We refer to a Nadex spread being in the money when the price of the underlying is trading above the floor price when trading the spread long, and if the price of the underlying is trading below the ceiling price when trading the spread short. That is also considered to be in the money. So again, if you consider the actual levels of the spread, so in this case, the 1900 to 1940, if you consider from here to be the money, okay, you're either going to be at the money down here, at the money up here, out of the money up here, out of the money down here, or in the money, all in this green area.
Oh, yeah, okay? All in the green area, because you can also go deep in the money. So even if you're above the ceiling price for a long, you are still in the money. Okay, it's in the money all the way up as far as this thing can go. If the indicative index was trading at 1980, this spread would still be in the money. Okay, it's because it's somewhere in the money. It has, and we'll get into this in the next few slides with intrinsic and extrinsic value. But that's why we're coming up with these definitions first.
Here's in the money for a short spread. Again, in the money anywhere in this red. Okay. All right. If the US 500 is currently trading at 1940, it's considered to be in the money. Or I'm sorry, below 1940. It's considered to be in the money in the spread. Again, there's a situation where you're deep in the money as well. And again, same thing with an example of this graph. You're going to see things repeated over and over again. Okay. This is not a typo. Ceiling price should be down here on a short spread on the graph. So again, if the US 500 is trading below the ceiling price of 1940, then the spread is considered to be in the money. Let's look at what Mike just mentioned, which is deep in the money. Okay? If the price of the underlying is trading way above the ceiling for a long spread, it can be referred to as deep in the money. For example, if the US 500 is trading at 1980 and the ceiling price is 1940, the long spread is deep in the money. If the price of the underlying is trading way below the floor price for a short spread, it can be referred to as deep in the money. For example, if the US 500 is trading at 1870 and the floor price is 1900, then the short spread is deep in the money. So that covers the terms we use for moneyness. And now Mike is going to go into why moneyness is important.
All right, thanks, Bob. So why moneyness is important? We went through all these definitions, and all right, we're at the money, we're in the money, we're out of the money. But what does it all mean? Great, we've defined some terms. It's important for two major reasons. Now, the first reason is to understand spread premium and what contributes to the premium paid for a Nadex spread. We've been showing you these graphs as if there was no premium in there, sort of what they'd appear at expiration. But you're never going to trade them at expiration. You're going to put them on sometime before expiration, because when they're expired, you can't really trade them. So you're always going to put them on with some time until expiration, and depending on where they are, you're going to pay a premium to do that. The second reason we're going to go through all this is so when you're learning different strategies, understand which spreads will be appropriate to trade. There might be times you want to trade something that is going towards deep in the money, or it's even above for the long spread. It might be even trading above the ceiling price. You might want to capture premium, especially if volatility is high. there are strategies you can learn. But if once we have a baseline with you guys, if we say, hey, we're looking to capture some premium and we want the price to stay at or above the ceiling, so when we put on the spread, we capture the time decay, then you're going to understand that about what we mean by when we say in the money or in the money above the ceiling price, or we want to put this on in the middle of the spread when it's in the money at the null point, or we want to put this volatility is low, we want to put this on at the money, whether we're long and short. You'll know exactly what we're looking. So if we say the indicative index is crude, the indicative index is at 41 and we want to put on a short spread at the money, everybody can go to their and look at the spreads out there and say, oh, here's one at the money that I could go short based off, we know it's trading crude at 41, so we want to find it with the ceiling price being at 41 or very close to 41. So, premium. I just alluded to premium. Up to this point, we really haven't discussed the concept of premium. But if you've traded options or Nadex spreads, then you've realized that you generally don't get to put them on for free. They're limited risk positions. Since they're limited risk, you're paying a premium to do that. You're going to have to pay up something to do that. And they're built from options. Options have time decay. Options, the price changes over time. The longer the time to go until it expires, generally a higher the premium, depending on, again, where the spread is trading. It is not like trading the underlying where you pay a transaction cost, but other than that, you are paying what the underlying is trading at the moment. All right? So that's the way that Nadex spreads are different. Now, there are two components that make up the premium for options and Nadex spreads. The two components are the intrinsic value and the extrinsic value. Let's take a look at these concepts. So, Nadex spread premium, we have intrinsic value, which is essentially the value at expiration. Or if it was to expire at that moment, it would have an intrinsic value, would have an inherent value. All right? Extrinsic value, a lot of people also call it time value. It's the premium on top of the intrinsic value. And at times, if the spread is out of the money, there is not any intrinsic value. There is only extrinsic value. So if you're putting on a long spread, like below the floor price that is out of the money, you're going to have to still pay, even though the spread's not worth anything inherently or intrinsically, you're still paying something to put it on, which is the extrinsic value or the time value that changes over time. Let's take a look at the intrinsic value of a long spread. The intrinsic value for a long spread is calculated by determining how much the underlying is above the floor price of the spread, how much it is in the money. If the underlying is not trading above the floor, then the long spread does not have any intrinsic value. That would be either at or out of the money. It would not have any intrinsic value. The maximum intrinsic value is capped by the ceiling price. So the maximum intrinsic value is always the difference between the floor and the ceiling price, or the maximum value of a spread. If it was like a 1900-1940 spread, the maximum value at that spread at expiration could be 40. For example, when the US 500 is trading at 1970, the 1955-1985 spread has an intrinsic value of 15. Why is it 15? Because the floor is 1955. The US 500 is trading at 1970. It's 15 points above 1955. The maximum intrinsic value of that spread also would be $30, because how do you get that? You subtract the floor from the ceiling. 1985 minus 1955 is $30. Let's take a look at this graphically. So, if the US 500 is currently trading at 1970, intrinsic value is 15. So, we show you, all right, remember the underlying is trading left to right. So it's trading, here's your floor price, we're trading $15 above the floor price. That's the intrinsic value as captured by this green line. That's what the spread is inherently worth at that point. If it was to go to expiration immediately at that, no matter how much time, if it was to expire at that moment, the spread would be worth $15. Intrinsic value of a short spread. Intrinsic value for a short spread is calculated by determining how much the underlying is below the ceiling price of the spread. If the underlying is not trading below the ceiling price, then the short spread does not have any intrinsic value. Again, it's either at the money if it's straight right trading at the ceiling, or it's out of the money if it's trading above the ceiling. The maximum intrinsic value is capped by the floor price. So the maximum intrinsic value is always the difference between the floor and the ceiling price. For example, when the US 500 is trading at 1920, a US 500 1900-1940 spread has an intrinsic value of 20. It's trading $20 in the money. The maximum intrinsic value of the spread would be 40. Again, that's obtained by always subtracting the floor and the ceiling prices and coming up with the difference between the two. Let's take a look at the intrinsic value of a short spread. Now we're trading at 1920, US 500 is trading at 1920, which is 20 below the ceiling price, so it's got an intrinsic value of $20. If it went to expiration immediately, the spread would be worth $20. That's intrinsically what it's worth. So now we've covered intrinsic value. What's extrinsic value? Extrinsic value is the other component that makes up the Nadex spread premium. All spreads, until they expire, have an extrinsic value, unlike intrinsic value, which out-of-the-money spreads do not have. So they all have extrinsic value depending on where you put them on, except there's a special case for that. Many people use the terms extrinsic value and time value interchangeably. However, this is not completely true. There are three main components that make up extrinsic value. So, extrinsic value, the three components, the time until the spread expires, and we'll get into that when we get into the Greeks, which is theta. Okay, there's a time component to this. There's also a volatility component. The volatility of the underlying, it's, you have historical volatility and implied volatility. Options are priced using an implied volatility component, which can be based on their historical volatility, but it's also based off the volatility of how the instrument is trading right at the moment. And the higher the volatility, it can change the extrinsic value and the pricing value. Just for the point of completeness, you also have rho, which is change in interest rate. We don't have to worry about that for Nadex spreads because we're trading them short term. And even if you're trading the day that rates were hiked or cut, it would have such a minor effect on your spread price you would not even know it. So we're really going to be focusing on the time and the volatility and how that leads into extrinsic value, how that contributes to extrinsic value.
And we're starting to get into now, guys, the things that you need to know to be able to trade these things correctly and profitably and consistently, because as simple as these products are, and as easy to understand as these products are, and as well constructed as these products are, there's a couple of things you need to know to trade them. This is not child's play. You're starting to get into this, and the relationship between the things Mike just talked about with the Greeks and how they relate to Nadex spreads is different than other options. That's what we're starting to lead into for the next few webinars.
So the two major components are time value and volatility. The more time that's left in the spread, the higher the premium will be. Time only moves one direction. So the more time, it contributes to a higher premium. And as the time decreases, the premium decreases, which people call time decay, which is theta. For example, a spread that has 8 hours left will have a higher time value than a similar spread with only 1 hour left. Let's say that the underlying did not move for 7 hours. Well, the spread, and it was, let's say it was at the money, or at long and at the money spread. The pricing 7 hours later would be different than with 8 hours to go. That time value is known as theta. The higher the implied volatility, the higher the premium will be. The volatility component is referred to as vega. Vega can change throughout the trading day. And I know some of you have seen it. If you've traded spreads or products or options around news reports, or you might see, hey, the spread's really high priced, and then a news report comes out, or a crude oil inventories comes out, or something that it was an expected thing comes out, and let's say the market doesn't move. Well, you see the spread, the premium change dramatically. That's vega. Or you might see volatility increasing. People are anticipating stuff, and even the market might not be moving yet, but the spread value could be changing over time, because implied volatility, what we say when we say it's getting pumped up. You know, when we were on the floor and we were options market makers, we'd be pumping up the implied volatility. Why? Because maybe we expected the markets to get more volatile going into a certain report. Maybe we expected there was a news conference coming out, and we didn't know what was going to be said. So we were pumping up the implied volatility, which changed the premium on the options or the spreads. So you're going to see these same things in the Nadex spreads because they're built from options. The higher the vega, the higher the premium. Or the higher the implied volatility, the higher the premium. For example, crude oil with an implied volatility of 30% will have a higher spread premium than an implied volatility of 15%, with all other factors being equal. If you're at the, let's say you look at the spread with 60 minutes to go, if the implied volatility instantly went from 15% to 30%, the premium would change on that spread. Let's quickly talk about the null point. There's a special point in Nadex spreads where the spread is in the money and there isn't any extrinsic value. There's only intrinsic value. We're going to call that point the null point, referring to the fact that there is not any extrinsic value. And this is something that's inherent to vertical spreads. It's the way it has to be. It's because they're constructed from two different options. So they have to act this way. That's why it's really beneficial to study these graphs and to know how they're constructed. This point is in the middle point of the spread, halfway in between the floor and the ceiling. All right, so here's how it looks with the null point. We've seen this graph before. The dark blue line is the way it would look at expiration. However, we're never trading it at exactly expiration because it's expired. You could be trading it with 5 minutes to go at expiration, but we then have a premium component. If you look, let's say we're going down along the spread at 100, okay, which is at the money. You can see over time with 60 minutes to go, the premium is going to be at a higher value than with 5 minutes to go. Why? Because with 5 minutes to go, there's not as much time left, so the theta has gone away. That's one of the major reasons. Well, what's interesting in these spreads is when they cross the middle, or close to the middle, because there can be skews, the way market makers might put on a slight skew or something else to take advantage to, because of their positions and how they want to hedge their positions, but roughly very close to the middle of the spread, no matter what the time is, they all cross, and that's the null point. See how no matter how much time, whether it's 60 minutes, 30 minutes, 10 minutes, 5 minutes, they're all crossing. So this spread, if we were to go long at that point, which this is a 100-105 spread, 100 is the floor, 105 is the ceiling, we put it on about 102.5, we're putting it on at the null point. It's intrinsically worth 2.5, and we're going to be able to roughly put it on for 2.5 because we're crossing the null point. There's no extrinsic value. One of the beauty things in the spread, and people then, some of the more advanced students may say, hey, well, wait, I have better reward to risk down here if I'm going long. Yes, but there'd be times that you want to put things on at the null point because of the way the spread's going to behave, because of the volatility components, depending on time to expiration, because you might be going long the spread at the null point to take advantage of a target that you have. And if it goes slightly against you, look, it doesn't drop all the way down right away. And we'll get into this in future webinars. But this is where you start understanding the benefits and the detriments of putting on spreads at different things. People may go, well, I'd never want to put on a spread up by the ceiling price. Well, you can actually, without the market moving, let's just say in this hypothetical market, you put it on at near 105, and you put it on with 60 minutes to go. All right, so yes, you're taking on more risk than reward. But let's say the market's stagnant and not moving anywhere. Well, this, you actually make money. You actually captured a premium without the market not moving, because at expiration it's going to be worth X amount of money, and you put it on for less than that. So by understanding these graphs, by understanding, all right, I want to put it on in the money close to the ceiling point because the market's behaving a certain way, or volatility is decreasing and the market's getting stagnant, I can do that strategy. Or maybe volatility is very low, so there's not a lot of time components, but we're getting into a volatile time where there could be a lot of movement. So I might want to put it on at the floor price. So I might want to put it on at the money or slightly out of the money because of the characteristics of this market. That's why we're going through all the moneyness concepts. That's why we're talking about at the money, in the money, out of the money. Because we're getting the language. So as we build on these concepts and the null point, we can say, hey guys, because of these market conditions and because this is the strategy we're using, here's how we could trade the spread. And you might have the same strategy and want to trade based off market conditions. You might want to put on a different Nadex spread because of the way the market's behaving, or because the volatility is high and going low, or because the volatility is low or going high, or because the market's gone stagnant and you're trying to capture your time decay and capture that premium. So those are all the reasons we're going to get into this.
This null point is a really important thing to grasp, because well, we want to make sure everybody grasps, and again, we're not talking down to anybody, we're not repeating the obvious. The null point is not this point with which you take the least risk. It is the point where you pay the least premium to be in the particular option. So there's different times where you're going to want to be at the null point, and like Mike just mentioned, there's times you're not. It's not the same as taking the least amount of risk, and I think the most important thing that Mike said was there are other points where you take less risk, but the probability of making money is not skewed in your favor because of the structure of the spreads and the conditions of the underlying market.
Right, you could put on a deep out of the money. You can go long a spread deep out of the money. Let's say in this hypothetical market where it's trading at 95. You might pay, a couple bucks to put on that spread. It's not worth anything intrinsically, and you have, you could be putting on spending $2 to possibly make, the $98. However, that might not be to your benefit because the likelihood of you actually making money with that spread is very low. And given certain market conditions, you might not want to do that. Now, there might be a time given certain market conditions when you would want to do that. Or maybe it's more beneficial to put it on at the money. And these are all things you're going to start to understand, especially as we keep building on these concepts with the Greeks. So there's a little premium calculation decision tree for those people who might need the help. And we can, if people are interested and want to come over to Path Trading Partners and sign up for this, we can send this out to you. Let us know if you're interested in. We can put this in a nice little PDF for you. But here's how you figure out for Nadex spread premium. And I like to build these decision trees, especially for trading models and trading strategies I do. So really you're asking if you're long or short. All right, if I'm long, I just follow the arrows. Is the underlying trading at or below the floor price? If it is, yes, the spread is either at the money or out of the money, and all the premium that you're paying for it is extrinsic. It has no intrinsic value. Let's say otherwise it's no. Let's say, all right, is a spread trading exactly in the middle of this floor and the ceiling? Yes, this is a special case. The spread is in the money with only intrinsic value. Why? It's at that null point. However, we say no to that. The spread is in the money, and the premium is both extrinsic and intrinsic. So we can then calculate the intrinsic value, calculate the extrinsic value. So for any of you who are still, getting down this concept and want help with this, contact us and we'll get you out this decision tree, and you can really start to get it down. You go through this a couple times, and then you're going to be able to just talk about it. Oh, yes, the spread's in the money. It's got this much intrinsically. It's got this much extrinsically.
understanding how much intrinsic, how much extrinsic will go to strategies. That's where that becomes important. Okay, it points to strategies. When you start getting into strategies with the Nadex spreads, again, you'll be trading these just dramatically complicated vertical debit spreads, call or put, but they're simple. Right? This again, I get so excited about teaching this particular subject, and there's other stuff we're going to teach. We're going to teach some binary stuff, but the spread stuff is so cool because you're actually getting into complex option strategies with a simplicity that isn't offered to you. A lot of the work is done for you already. So again, go to our website and we'll send you this so you can it's kind of an exercise you can go through. In this webinar, we cover the concept of moneyness and how to know if a spread is in the money, at the money, or out of the money. And this naturally led into the concept of spread premium and intrinsic value and extrinsic value. We looked at how to determine both intrinsic value and extrinsic value and the components that make up extrinsic value. We also looked at the null point of Nadex spreads, where a spread is in the money but does not have any extrinsic value. So let me just conclude this in my own words, and then I'll talk about what we're going to do next time. This is the structure. This is the construction and the foundation of not only the spreads, but of terms and knowledge that you need to kind of grasp in order to make these Nadex spreads a staple of what you trade in and out of on a daily basis. And these are extremely good products. The structure of the product is such that there are several different strategies you can impart into the markets and be very consistent with these particular types, with these particular bits and pieces of knowledge. So in this particular class, we touched on theta, time value, and vega, which is volatility, as it relates to the concept of extrinsic value. Remember, the intrinsic value is math. The extrinsic value varies. In the next webinar, we'll examine all the Greeks as related to Nadex spreads. We'll go in depth into delta, gamma, theta, and vega to see how they affect spread pricing. I said this in the last two webinars. I'm going to stress it even more in this one. Do not get intimidated by these terms. Once you know what they are, they're just names for very simple concepts. And once you get them, they become second nature very, very quickly. Knowing these concepts is important to understanding how and when to trade the spreads, to trade the different duration and ranges of Nadex spreads. There is very little point to getting involved in a product without understanding what it is. And Mike and I talk about the Nadex spreads with such excitement and affection because these can become the core of your trading, these particular products. You'll always trade binaries, right? And we've got some binary strategies and a couple binary webinars we're going to do for you guys as well. But the Nadex spreads are such a unique, simple, and effective product that if you just take the time to say, okay, I'm going to learn delta, gamma, theta, and vega and how they affect spread pricing and how they help me understand when to trade the different durations and ranges of these spreads. You just take a little bit of time to learn that. It's not as much as learning the variations of traditional options and the different mixes between diagonals and calendar spreads that you can get into, okay? It's not as bad as that. It gives you into a simple sort of a funnel to understand options in general. So thanks again for being here. We do have a question about how to see the first two webinars. If you go to the Nadex YouTube page, okay, and then you look under webinars archives, both those webinars are in the playlists, as I'm sure this one will be as well. You can visit us at Path Trading Partners. The link to the YouTube is there as well. And please, if you could, follow us on Twitter, like us on Facebook. And we've got a live class starting December 7th. Okay, we're going to do a free webinar on December 7th, leading into a live class that we're teaching that's going to go into strategies. So again, visit us there, join up. We've got one more, again, Tuesday of next week. That's going to conclude the sort of spread construction and spread basics on the Nadex spreads. and that'll give you the foundation you need to affect strategies you learn from other people or strategies you may choose to learn from us. You'll have the core foundation you need. And we're going to leave these replays up pretty much indefinitely so you can watch them. You should watch them over and over again, and you should not be intimidated by anything, any verbiage, any terms, or any of the math that's in these things, because it'll click. The light bulb will definitely go on for you guys. So if there's any other questions, I'm happy to answer them. Mike's here. Otherwise, we'll turn it back over to Chip and Nadex, and we'll move on to next week's webinars.
Okay, well, Bob and Mike, thank you so much. It was really a great webinar, guys. You're really giving everybody the building blocks to take it to the next level. It's good stuff. So again,
that's a great way to put it, Chip. That's what we're trying to do. Again, that foundation, those building blocks are going to get you guys to the point where you're not just trading a live Nadex account, you're trading it consistently. All we want is consistency out of our traders. That's all we need.
Okay, well, good. Well, listen, if anybody has some quick questions, we can fire away. Otherwise, you, as Bob said, next week, same time, we'll get it, the registration page up there tomorrow. And also, if you want to watch this, rewatch this webinar, we'll get that on the Nadex YouTube page in the next day or so as well. So thanks again, guys.
Thanks, Chip. Thanks, Nadex. And thanks to everybody for being here. We'll speak to you guys next time.
All right. Take care.
Thanks, everyone.